Okay. Good afternoon and welcome to Sensible Financial Planning's webinar, The Basics of Estate Planning, Part 2, Saving on Estate Taxes with Trusts. Pardon me. I'm Carrie Fristo and I'll be your moderator. Today, Frank Napolitano will discuss the importance of trusts in saving estate taxes and how to incorporate them into your estate plan. Frank has a BA from Harvard University and a JD in Business and Financial Law from Boston University School of Law. He is both a certified financial planner certificate and a chartered financial analyst charter holder. Frank is a member of the National Association of Personal Financial Advisors, NAPFA, and the National Association of Divorce Professionals. As you may know, we present webinars each month on a variety of financial topics. You can register for upcoming webinars through a link in Sensible Financial's newsletter published later this month or at sensiblefinancial.com/webinars. There will be a Q&A session after Frank's presentation. Please submit your questions through the Q&A link that's at the bottom of your screen at any time during the webinar. We're also going to do something a little different today. Frank designed a poll, which we'll launch during the webinar, and your responses will be anonymous. Frank is going to answer as many questions as he has time for. He can't give personal advice in this setting because there just isn't time to gather the information or the context necessary to do so. But we will provide contact information for Frank at the conclusion of the webinar, and we'll be sending you a link to the recording as well. Now, Frank will begin.
Well, good afternoon, everybody. Good morning to anyone else who's here on the West Coast. Let me share my screen. Wonderful. Again, thank you all for joining. My name is Frank Napolitano. I'm a senior financial planner here at Sensible Financial. I guess I'm a JD, CFP, and CFA charter holder, although this webinar is from the perspective of a financial planner. So we don't do any document preparation from a legal perspective. We certainly do not do taxes. And so nothing in this webinar should be construed as legal or tax advice. This is really our and my experience coming at this as a financial planner. This is my second webinar on the topic of estate planning. If you missed the first one, which was well attended, and I think people appreciated it, I'd recommend you watch it. If you saw it already, you might sort of rewatch it at some point for a second pass, as I'll be sort of diving into one or two topic areas in more depth here, and I won't be able to go through all the things I covered in the last webinar. So this is really a webinar that deals with the estate tax and the way the trust can be used to reduce and minimize estate taxes. So my goals for today are to sort of introduce the estate tax, define it, give an example, and then show how trust can be used to reduce or eliminate estate taxes. And finally, to end with sort of what are the pros and cons of using trust as part of an estate plan. Again, we'll focus on estate taxes, but also to broaden the question a bit there. And hopefully to give people a sense of the various factors that are involved and the types of questions to ask yourselves when you're working with your estate planner on whether to go for one type of estate plan that uses wills or maybe another type that uses trusts. But I want to start with a poll, which we used these for the first time in my last webinar, and I really liked it, so to be able to get some feedback from you, the participants here, and to the extent that I can tailor some of this webinar presentation to the people who are here. So we have a question for you all, which if you have an estate plan, does it use trusts? And you can answer in sort of one of four answers here. So we're going to give everybody just 30 seconds or a minute here and review those answers in just a bit. So please, if you can answer the pop-up on your screen here, submit that, and we'll review the answers in just a moment.
we have 62% who said A, my estate plan uses trusts.
Okay.
And then 19% my estate plan does not use trusts, and another 19% I do not have an estate plan. And then everyone knew. No one said I don't know, which is probably good.
Good. Good. Okay. So great. So many of the people here may be familiar with, for example, the notion of irrevocable trust or irrevocable trust or a living trust. That's two ways of saying the same thing. I'm going to touch on that in just a little bit. And for those of you who don't have an estate plan, I think this may be a useful way of thinking through the estate plan. For those of you who have an estate plan that goes through probate or will-based estate plan, I'll be touching on sort of the probate versus non-probate aspects of estate planning as well when we get there. So a nice mix of an audience here. So okay, so I'm going to begin with the estate tax, and let's first define what that is. So the estate tax is a tax, right, which is levied on a deceased person's gross estate with some adjustments. If you think about the gross estate at a high level, it's sort of all of the property that somebody owns when they pass away. That person, the person who's passed away, is sometimes called the decedent. I try not to use too much jargon here, but if I use decedent, just understand that's the legal way of saying the person who passes away. So the decedent's gross estate, and that gross estate is adjusted by two items. So there are certain deductions that the estate can take upon death, and there's an exemption amount. And I'm going to focus mostly on the federal question here, simply because we're using sort of very general high-level examples here. So the exemption amount, as of today, you can think about it as there's an income tax, and everybody gets to exclude a certain amount of income. We're taxed on our net income, not on our gross income. And so just like the standard deduction is to the income tax, the exemption is to the estate tax. And as of today, that exemption amount on the federal level is very, very high. It's about $13 million per person. So that's a very large amount, which is automatically excluded from anyone's estate. So with that said, with so few Americans that are pulled into the estate tax, it's a fraction of 1%. Why are we spending our time talking about the estate tax and how trust can be used? Well, there's at least two things to keep in mind here. So one, that exemption, that high exemption, historically high, is scheduled to sunset in 2026. So the Tax Cut and Jobs Act, which introduced many changes to the tax code. One of them was a much higher estate tax exemption, which has been adjusted for inflation over time. If Congress doesn't do anything, that will sunset in 2026, and we'll go back to an estate tax exemption that is at the time $5 million, which years ago, now adjusted for inflation, would be somewhere around 7 million. So the exemption will be cut in half. Still very high, but almost half of what it is today. That's point number one. Point number two is there are states that continue to levy their own estate tax. And there are 11 states as of today, plus the District of Columbia. They have their own estate tax and limits. And often the exemption amount is much smaller. So if you live in a state like Massachusetts or Oregon, the exemption amount is $1 million. So many, many more people can be pulled into the state estate tax regime than they can, or than that do get pulled into the federal estate tax regime. So let's turn to the gross estate, and in just a minute here, I'm going to talk about, through an example, sort of how the estate tax is calculated. So remember, the estate tax is the tax which is assessed on a decedent's gross estate. So this is the value of a person's property at the time of their death. This includes things like personal property, so car, the contents of your home, certain insurance policies. I think people are familiar with the fact, or may be familiar with the fact that life insurance, for example, if you own it in your name, even though it passes income tax-free to beneficiaries, it is included in your estate, in your gross estate, for purposes of the estate tax calculation. That's important. But other insurance policies could be included here as well. So for example, if you purchased an annuity, a straight life annuity, let's say, which may be increasingly popular today with higher interest rates, right? Higher rates, higher payout rates, and more annuities look attractive. If you thought, well, I could just, reduce my gross estate by buying $1 million worth of annuity, it doesn't work that way. Although the dollars you use would be out of your estate, the IRS would use a present value calculation, essentially what are the things worth, in order to bring those into the gross estate calculation. That's an important point. The gross estate includes things like financial accounts and, of course, real property such as a home. And one point here, I think we'll come back to it, is that the gross estate includes probate and non-probate property. So it's not the case that all trusts simply remove property from a person's estate. You can retitle. So for the almost 70% of us, I think, who said, well, we have an estate plan with trusts, those are almost certainly living trusts, which are used effectively to do things like avoid probate, create a more sort of private estate settlement, but it doesn't reduce one's gross estate. That's an important point. Let's turn to the estate tax calculation. So like I said, we begin with the gross estate, and we make two adjustments. So to the gross estate of the decedent, we first subtract a number of deductions. This is not a full list of those deductions, but give you an example of some of the most common deductions that exist. So you're allowed to deduct funeral expenses of the decedent when calculating the net estate. You can subtract debts. So if a primary home is included, right, property is included in the gross estate, you could reduce the amount of the gross estate by the amount of, let's say, the outstanding mortgage. There's a spousal deduction. This is a very important deduction. This allows the first spouse to die to pass up to 100% of the estate, of their estate, to a surviving spouse. And there's charitable gifts. I did another webinar on charitable giving here and estate planning, and essentially if somebody says through their estate plan, I wish to give my entire estate to charity, well, gross estate becomes zero, net estate is zero, and there's no estate tax due. So the first adjustment is the number of deductions here. Again, a lot of variability here depending on giving and if there's a surviving spouse. And then we reduce it further by some exemption. And again, that exemption amount today is very, very high. So for most people, the gross estate is less than the exemption. And so the exemption brings the gross estate to a negative number. You cannot have a tax on a negative number, but all else equal, gross estate with these two adjustments leaves you with a net estate to the extent that that net estate is positive. That gives you your basis for determining the estate tax due. So we multiply that by some tax rate. Tax rates, if it's a progressive estate tax, like let's say in Massachusetts, and that leaves us with an estate tax. So I think about the estate tax as conceptually similar to the income tax, but two major differences. Right? One is it's assessed on a per person basis. So there is no joint estate tax return. It's assessed on somebody's on someone's death and on their gross estate. And two, there's a lot more flexibility. There's a lot more ways of getting to zero, or getting to a zero estate tax liability. So just look at the deductions for a moment, right? On the first spouse's death, they could say, well, I'm going to give my entire estate to my surviving spouse. Gross estate goes to zero, zero estate tax due. Or I decide to give my entire estate to charity. And again, if it was a $50 million estate, it can still reduce that gross estate to zero and zero estate taxes due. So with that said, with all the seeming flexibility of this estate tax regime, who has an estate tax issue? Who has to worry about this? Historically, estate planners have focused on married couples, and the issue has been to try to maximize their combined exemption. And the idea here is because The income tax, people can file jointly. There is no joint estate tax return, and so there are sort of two separate estate taxes going on. So, a simple example, right? To avoid estate tax, when a first spouse passes away, they could simply write into their will or their trust or both, I hereby transfer my entire estate to my surviving spouse. Zero estate tax due at that point. When the surviving spouse passes away, here's the issue. Without some planning, perhaps, and that person's estate could owe more tax than necessary, because without proper planning, they might fail to get the benefit of two estate tax exemptions. They each have their own estate tax. And so much of estate tax planning for couples has been to try to solve this problem. It's been to try to maximize the exemption amount. If that's done properly, it can double the amount that can otherwise be transferred tax-free to heirs, to the next generation. So let me show you an example here. Again, I find this a lot easier to think about with numbers. So we have a married couple, and on the death of the first spouse, they have a gross estate, like the sum of all the property in that person's name. Let's just assume that it's all the household property, just to make it simple, of $3 million. Okay. So they listened to the first, 15 minutes of this webinar. They said, I can give everything to my surviving spouse, zero estate taxes due, fantastic. And that's what they do. They deduct the full amount using the spousal deduction and leave it to the surviving spouse. There's an exemption amount here of $1 million, but it's not needed, right? Because 3 minus 3, the net estate is already zero. The exemption is not used in this case, and the net estate is less than zero. There's no estate tax in this situation. So visually, right, using the spousal deduction to transfer that $3 million to the surviving spouse. Years pass, and the surviving spouse passes away. And to make the math simple again, let's assume that her estate is $3 million. So maybe she's drawn down some of the IRA, but the value of the house has increased regardless. It's the same $3 million amount. Now, upon her death, she has a certain amount of deductions. I've made this number up, $500,000. Let's say it's the sum of funeral expenses, the remaining mortgage on a house, and maybe some charitable gifts. Doesn't really matter, right? But there is no surviving spouse to leave the estate to, right? And so she's limited in her deductions in my example. So a $3 million estate minus $500,000 becomes $2.5 million. Upon her death, her estate files a tax return, and they claim the $1 million exemption. $2.5 million becomes $1.5 million, and so the net estate here is $1.5 million, and the estate tax would be assessed on that $1.5 million. Right? But had the couple been able to use their combined exemption amount, right, they would have been able to save an extra $1 million off of the gross estate, and the net estate, therefore, the taxable estate would have been only $500,000. So the question here is, how do you get this exemption, right, which is tied to an individual, sort of from this point in time to here, to fully maximize this household's exemption amount, because that's not how the estate tax works necessarily by itself. So this can be done. This can be done with a little bit of estate planning, and this is where trusts come in. Now, my last webinar, I gave basics of estate planning, sort of one of trust, and lots of different things. Here, I'm just going to sort of briefly introduce sort of what is a trust, and then I'm going to spend most of the time talking about the difference between two sort of broad categories of trust. So first of all, what is a trust? So a trust is simply a legal relationship in which a trustee holds property for the benefit of someone else or some group of persons. Okay, a trust involves at least 3 people. So there's a grantor. This is the person who creates the trust or creates the trust with the help of an attorney. They're the person who funds it, essentially. There's the trustee. This is the person who holds and manages property for the benefit of the beneficiary. This is the person who's entitled to benefits. Trusts are very, very flexible. With certain trusts, the grantor, trustee, and beneficiary could be all the same person. In other situations, they're all different, or the grantor is the trustee and the beneficiary is someone else, and all these various sorts of combinations. But within the sort of trust regime here, there are two major categories to think of, and they're treated quite differently from a tax perspective and a creditor protection perspective, and those are revocable and irrevocable trusts. Right, so going back to that earlier poll, and many of us here in the audience said, well, I have an estate plan and it uses trust. I'm willing to bet that for most of you, the plan is using revocable trust, also known as living trust, and this is a way of primarily managing property in the case of incapacity and transferring property upon death, usually avoiding probate, not necessarily, but usually avoiding probate. Irrevocable trusts are different. They're often funded, and especially for purposes of this webinar here, estate taxes and trusts, they're funded after death, and they can be used in this example to protect a surviving spouse and minimize estate taxes. Right? Protect a surviving spouse, minimize estate taxes. How can irrevocable trusts be used to accomplish these aims? We can compare the two and sort of illustrate the differences here with another example. So for a revocable trust, with ownership, control, asset protection, and the estate tax, the topic of this webinar. So who owns a revocable trust? The grantor, the person who funds that trust. If I have an estate plan and my attorney helps me draft up the Frank Napolitano 2023 Living Trust, that trust and I are functionally the same person. I completely control the property in that trust while I'm alive. It's owned by me. The assets in the trust are controlled by me. There's a point here, right? I think there's a misconception that, trusts always save on taxes. I'll get to that in just a second, but revocable trusts do not save on taxes. They certainly don't save on income taxes, right? In fact, while the grantor is alive, they have no impact on income or estate taxes. Because you have control of the trust, it is included, recall the definition of the gross estate is everything you own or have an ownership interest in upon your death. The assets in a living trust are included in your gross estate. Okay. Asset protection with revocable trusts. So the grantor, the person who owns the trust, the person who's funded the trust, is liable for claims. You cannot avoid being sued by putting your assets into a revocable trust, because after all, you control those assets. They are still functionally your assets. For estate tax purposes, the assets are included in your gross estate. Again, if you own the asset upon death, you own the assets in your living trust upon death. Those assets are included in your estate for purposes of calculating the gross estate. Now, an irrevocable trust differs in several important ways. First of all is the ownership. So the property is irrevocably given to the trust. Grantor helped establish the trust with the help of an attorney and funds it with $1 million, let's say. That $1 million is now owned by the trust. The trust files, with the help of the tax accountant, its own tax return. And for all intents and purposes, that $1 million is now outside of the grantor's estate. The grantor does not control the asset. This is another part of it. So a trustee must be selected who manages the property, again, for the benefit of some beneficiary or group of beneficiaries. From an asset protection standpoint, well, assets in a trust such as this are generally beyond the claims of creditors. What is the benefit here? If you funded a trust like this for minor children or for a surviving spouse, and they were the subject of a lawsuit, and they were sued for everything that they own, well, the assets within that trust they do not own. Once the assets come out, they can become part of their estate. That's true. But the assets kept in a trust such as this are generally beyond the claims of creditors, assuming all the legal rules are followed here. And that's an important distinction, very important distinction between irrevocable trust and revocable trust. Again, from an estate tax perspective, well, if your gross estate includes everything that you own when you die, by definition, this is not owned by you, it's owned by a trust, and it is outside of your estate when you pass. Okay, and so through using an irrevocable trust, is how we can get the estate tax minimized and really sort of take advantage of that dual exemption, the exemption both from the first to die spouse and the second die spouse. And I'm going to show that with an example right now. Okay, so to recall the previous example, right? The first spouse passed away and left everything to a surviving spouse. Years pass, her surviving spouse then passes away herself and gets the benefit of one exemption amount to reduce her estate. Okay, well, I should have said this earlier. The numbers I'm using are not the federal numbers or anything like that, obviously, right? I'm just using $1 million as an exemption to make a simple point. So we could slightly change the fact pattern here and get it so that this household is able to get the full benefit of their joint exemptions. So again, let's begin here. The first spouse passes away with a gross estate of $3 million. Okay. They take advantage of the spousal deduction, not to the full amount of the estate, but to $2 million, okay? Leaving $1 million in the person's estate when they pass away. So again, 3 minus 2, that leaves $1 million in the estate. And step 2 is to apply the exemption amount. Well, 1 minus 1 leaves us with the net estate of 0. So same effect for purposes of the estate tax calculation. There's no estate tax due on the first spouse's death. And what does this look like graphically? Well, through means of the will or their trust, if they're using trust in their estate plan, taking full advantage of the spousal deduction to transfer $2 million to the surviving spouse, leaving $1 million in the estate, and there are instructions in the estate plan to create a special type of trust, calling it a B trust, because in the past, these types of plans, which are much more prevalent, would be called like an AB trust structure, or sometimes this trust is called a bypass trust. Sometimes it's called a credit shelter trust. At the highest level, it is an irrevocable trust that is funded in the amount of the estate tax exemption. In this example, it's $1 million. And now this trust, remember, which is its own legal entity, is sitting outside of the surviving spouse's estate. Now, there's usually a provision in this trust. It doesn't have to be, but if the goal is to protect the surviving spouse, like I said earlier, there's usually a provision to send income to the surviving spouse during the surviving spouse's life. So today, if the trust was funded with $1 million and they purchased all government bonds, and the rate on treasuries today is call it 5%. Well, every year or every quarter, the trust would make distributions of income to the surviving spouse. So long as the income is distributed, there's a special rule in the tax code that says that income is taxable to the surviving spouse as opposed to the trust. And the $1 million remains in the trust, but I'll come back to that. Okay, so this is going on. Years pass, and the surviving spouse passes away. Now, again, to make the math simple, let's assume that the estate upon her death is the same amount that was passed to her via the spousal deduction on the first spouse's death, so $2 million. So what does her estate tax calculation look like? Well, she begins with a gross estate, $2 million. We apply 2 adjustments. Apply deductions, okay? And in my example, I'm saying, well, it's $500,000. Let's say that's the sum of the mortgage, funeral expenses, and maybe some charitable giving. So $2 million gross estate becomes $1.5 million. She gets the value of her exemption as she did before. And now $1.5 million becomes 1/2 minus 1 is $500,000. And so her net estate now is $1 million less than it was without the benefit of this estate plan or without this strategy. And this $1 million trust out here, again, it never comes into the estate tax calculation because she doesn't own the assets in the trust. The trust is the owner of this $1 million bypass trust, or whatever it would have grown to or declined to over the course of so many years. So that is the sort of fundamental way, or I should say historically, when we used to see these a lot, and could be seeing them again in the future, certainly see them in states like Massachusetts and Oregon. That's how to structure this in such a way to take full advantage of the household exemption or both spouses exemptions to effectively double the amount that can be passed to the generation after this household after estate taxes. Okay, just a couple points here now about some of the benefits of this approach, some of the pros and cons, right? Because some of us on this call don't yet have an estate plan. And so if you don't have an estate plan, if your estate plan just uses wills and you're thinking about, does using trust make sense for us? Let's talk through some of the factors here. So first of all, right, what are some of the benefits of using an irrevocable trust in this way? Well, you can minimize estate taxes. Like to the extent that you would fall within a federal or even state estate tax, you can minimize or possibly eliminate, depending on your situation, the estate taxes owed by fully utilizing two persons exemptions. There's asset protection. So as I said earlier, comparing revocable and irrevocable trusts, that irrevocable trust, that B trust in my example, is now outside of the surviving spouse's estate. Were she to be involved, let's say in a car accident, and she's sued by the survivors of the family or something, well, that they could go after the assets in her name. They might be able to go after her IRA assets even, or maybe equity in the house, but they couldn't go after the assets that are in the trust. What are some other benefits? I've sort of touched on this in my earlier webinar, but there's privacy, right? Estate plans that use trust, generally speaking, tend to be more private than estate plans that go through probate process and wills, right? Because you can go to the courthouse and pull up a will, pull up an estate plan of anybody who passed away through the probate process and print out those pages, or 5 cents a copy. And there's predictability or more control. So because you can attach rules to irrevocable trust and under what circumstances payments could be made, it's easier to structure something that's that may make more sense. Particularly, we think about clients with young children, right? It wouldn't make sense to leave a large life insurance policy, perhaps, to an 18-year-old. You could fund an irrevocable trust here, or put the insurance into an ILIT and control that after one's death and sort of distribute assets over time. But there's a flip side to that, right? The more control you exert, the more difficulty it could be for the survivors. When we talk about sort of all of the potential cons here of this approach, these the cons that I came up with. So time, expense, less flexibility, and this I'll touch on very briefly. So what I mean by time is that the implementation of this type of estate plan tends to be more work. A wills-based estate plan, if you say everything will go through probate, and we have this will, and we make adjustments to it over time, and at the point of death, there will be a probate process and they read the will. If you set up an estate plan using trusts, there will be more time. There'll be more time on putting together the estate plan at the beginning. And this is the one that we really see problems with, is implementing the estate plan, because the If you're using living trusts, I'm talking about revocable trust now. If you're using revocable trust as part of your estate plan, you generally have to retitle assets into the name of the trust. That takes time. And I think in my experience, most people don't do it. That's a risk. There's the expense associated with it. There's the expense both on, again, the front end of the estate plan itself. It'll cost more money to put together an estate plan that uses trust. Certainly, if you were to use an ILIT, the cost of these can become very expensive. But even in the future, managing an irrevocable trust, if you're hiring a professional trustee, for example, can be more expensive. So you have to weigh that against the potential benefits. There's less flexibility for heirs from the standpoint of that surviving spouse now. Think back to my previous example. So he or she is receiving income regularly from that trust. And there are benefits there too, like the asset protection, but it's not as simple as having $1 million in a bank account and writing a check for $50,000, right? There are rules that have to be followed to keep the money protected. And there are also rules that go beyond simply the income, but when somebody can access the principal within the trust. So it's necessarily less flexible. This is a minor point. I won't spend too much time on it, but I say potentially higher capital gains tax for beneficiaries. When somebody passes away with capital assets, so assets with a gain, that gain gets wiped out upon death. So if you own $100,000 in Apple stock, you paid $50,000 for it. Ordinarily, there would be a $50,000 gain, and upon your death, you get a basis step up. But the basis step up only applies to the death of a natural person. If on the death of the first spouse, you fund this $1 million trust, and now there's securities in that trust, years in the future, when the second spouse passes away, yes, the second spouse gets a basis step up for all the assets in her name, but the beneficiaries, maybe the children in this case, would not get a basis step up for the assets in the trust, because the trust isn't a natural person, and so you can only get the basis step up once. It's a nuanced kind of minor point, but something I just wanted to mention there. Okay, so pros and potential cons of the approach. There's a lot of sort of devil is in the details here. Understand I'm vastly oversimplifying the type of estate plans that exist. This is just one example. And so it's, this is really the type of thing that you'd be speaking with and sort of working with an estate planning attorney, tax accountant, financial planner to come up with an estate plan that makes sense for you. But I hope we were able to get through what can be a pretty complex topic here, estate planning and state taxes and trusts. And I want to leave you with my sort of high-level summary here, right? So the estate tax is assessed on the decedents, that's the person who passed away, right? Gross estate, with those two adjustments, the deductions and the exemption amount. The federal estate tax exemption is currently very high. Very few Americans have an estate tax issue from this perspective, but it could change in 3 years. And if you live in one of those 11 states or the Districts of Columbia that has its own estate tax, your estate tax situation will look different. Trusts, certain types of trusts, right, can be used to reduce or even eliminate estate taxes. And these types of trusts have other advantages and disadvantages that must be carefully considered when you are putting together that estate plan. So weighing those pros and cons. Thank you all very much. That is my webinar. And I see we have a couple of questions here. We can open up the floor, Carrie, and I will do my best to answer these questions.
Sure. Will has a question. He asks, if someone has a revocable living trust and at the death of a grantor, a trust needed to be opened for the assets to flow into before being distributed to beneficiaries, would that subsequent trust be considered a non-grantor trust in the eyes of the IRS? He said essentially he's trying to understand the difference between a grantor versus non-grantor trust in the eyes of the IRS.
Yeah, that's a good question. And actually, I don't know the answer to that. In my experience, the grantor trust has been just that situation, an RLT, irrevocable living trust. And then if a subsequent instrument is created, like so upon the death of the grantor, now an irrevocable trust is created. Sometimes I've even seen it where, trust for the benefit of the children or something like that, another set of living trusts are created. But whether the IRS considers those subsequent trusts non-grantor trusts, I don't know the answer to that question. That is one for the attorney.
Okay. AJ asks, is it necessary to file an estate tax return at the first and/or second spouse's death if the assets are minimal, say $200,000 to $300,000?
Right. So there's that's both a question of state tax filing and federal tax filing. Now, I know at the federal level, again, most people never have to file a return. At the state level, it just depends. So in Massachusetts, for example, I know that some people have to file the estate tax return, even if there's no estate tax due. There's sort of a threshold amount, and then they have to file an estate tax return, prepare one. Most people who have that question will have to figure that out on the state level. And that's, again, that's a question, I think, for like the tax accountant or CPA.
Okay. Yeah, okay. If this person inherited later in life in his or her 50s and continued with and has Medicaid for healthcare, can a trust protect assets for recovery? It says, yeah, I just.
That's really a sort of Medicaid trust question. There are Medicaid trusts, and there are ways of structuring assets to sort of fall within the Medicaid exclusions. I know that. I can't answer that specific question because that's a very, very specific question. And that if you or someone sort of in that situation or anticipating that situation, that's where you really need to get sort of a Medicaid or attorney who understands the rules around Medicaid and sort of set that thing up in advance. There are, I will say high level, there are strategies such as like disclaiming assets and things like that you can avoid those assets from coming into the person's estate, but it's very situationally and also state law specific.
So this person asks, are single people out of luck? What other, since you don't have a spouse, you can't avoid probate in that regard. You can't just leave it to someone without an estate tax. What other consequences are there of just being single?
Sure. So that's a good question. There's a very narrow focus of this webinar, which is really about sort of reducing or avoiding state taxes. There are other things here to expand the discussion a bit. So if you said, I'm an unmarried person, right? I'm an unmarried person, and I might fall within the estate tax limit here. And I'm using a simple example, a state like Massachusetts, because it's $1 million exemption. One of the strategies you could take advantage of, if you were concerned about that situation, my state is $1.5 million, right? You could gift during your lifetime, right? If you said, I don't know if you're thinking about sort of pure estate tax avoidance or how to gift to loved ones, family members, or something like that. But if it's the latter, you could gift in certain limits every year, and those gifts reduce your taxable estate, right? So that means you'd have to sort of do it over time. That's one method. As a single person, if you're saying there are other reasons where a trust might make sense. If you were, I had this with a client who has a brother and he's developmentally disabled, right? And their estate plan includes an irrevocable trust for him, so that if they pass away first, that asset wouldn't simply go to him unencumbered, but a trust would be created for his benefit that follows certain rules so that this person could, yes, inherit the assets of the life insurance for exactly what asset they used, and that person wouldn't lose their benefits. So there is planning around this. So there's this type of planning for single persons as well. It might be the topic of another webinar. I haven't thought about it hard enough yet.
Lawrence asks, can you comment on the concept of portability, whereby the death of the first spouse, whereby currently with the death of the first spouse, the remaining exemption can pass to the surviving spouse to use.
Okay, so portability. This is one of those jargony words. I didn't have time for it today, but let me explain what the concept is. So portability says, well, think back to that first example. You have the spouse passes away, and then 10 years later, the second spouse passes away. You say, but what about the first person's exemption? That seems unfair. That they would have had to, create an estate plan and fund a trust in order to do this. Some states, and at the federal level currently, portability allows for, remember that sort of arrow across time, allows for the transfer of that otherwise lost exemption to the point of the second spouse's death. That's what portability stands for. It's a bit complicated because, again, it's state specific, and you have to know, and for most people today, they care about the portability rules per their state, right? Because most people don't have a federal estate tax issue. But you're right. If you're just thinking about this type of estate plan just for purposes of saving estate taxes, it might not be necessary if your state allows for portability. Again, I think the conversation with the state planning attorney is something like, are there other reasons to maybe do this? Right. Asset protection for the surviving spouse. I mentioned, my client with a brother, a disabled brother. Other people use it for various reasons. So.
Okay, we have a question from Harvey. If you put a house into an irrevocable trust, what is the cost basis of the house? Is it when you transferred the property into the trust?
Yeah, that's a good question, Harvey. I don't know. We've had clients do this. Why? Why would you put the house in there and potentially give up, some of the? So Harvey's question is a little complicated from the standpoint that, again, when you die with an asset or the capital asset, you get a basis step up, right? But also there were special rules surrounding the house. Like if you later sell the house, there's a $250,000 capital gains tax exclusion and $500,000 exclusion for married couples. The house is often part of the estate plan, as I've seen it, because it's often people's largest asset, right? And you're not going to put an IRA in a trust. The IRA is a contractual account. I don't know the answer to it. I believe it's carryover basis, but that is absolutely a question for the tax accountant. I do recall there are pros and cons of putting the house in a special type of trust that can own a house, but have to ask the accountant there.
Okay, here's another question. What happens if an estate spans multiple states and at least some of the states have estate taxes?
I don't know. I have clients with, let's say, primary residences in Massachusetts, and she owns a ski house in Vermont. And I think there is some question as to where your primary residence is, but I will be honest, I do not know the answer to that question. And again, if you think you are, or if you live in one of those states with an estate tax, that's really, really important to know. And especially we see a lot of our clients who are in Massachusetts, they very quickly get above the $1 million exemption. There's a lot of state-specific questions here. I just want to be very clear. These are nuancy, and the laws are constantly changing. The reason I'm not trying to be coy, but really, you sort of need somebody who's doing this all the time, and they're up to date with the laws. And every single year, states with estate taxes, often the exemptions are on like a phase up or a phase out even. So they're very, very specific questions. I just don't know how to answer. I can't answer.
Okay, let's see. We'll ask another question. The unified estate and gift tax is currently 12.9 million. Now, is the GSTT a separate and distinct amount of 12.9 million in addition to that, thus 12.9 million on its own, or is the amount a total combined 12.9 million?
Okay, so we'll ask a question about the generation skipping transfer tax. This will be a separate webinar. I will do this because it's an interesting topic. There's a lot of confusion about how can you gift multiple generations down, et cetera. And Will, I'm going to ask you to sort of push that one off this side, and I will do this. There's not enough time to talk about the GSTT here, and I barely touched on sort of lifetime gifting and what that means for the unified gift amount. But I will do that in the future. That's an interesting topic area.
Okay, here's another one. If you put a house into an irrevocable trust and you have low income benefits, but the trust generates income while you're alive, do you file the income under your own personal taxes and lose the low income benefits, or under a return for the trust?
I don't know.
Another tax,
yeah. I mean, and state benefits, and I'm sorry, I don't know. Yeah. And there might be 50 different answers to that question from 50 different states.
Right. Here's one from Jeffrey. Will assets in a revocable trust get step up for capital gains?
Right. So during the grantor's life, yes. So often what happens in an estate plan, let's say I create a estate plan, I create the Frank Napolitano 2023 Revocable Living Trust, and I move my stocks into that account. And again, because I'm still alive, right? It's a living trust. On my death, you get the basis step up there, right? Now, if subsequent to my death, that creates a living trust for my partner or some sort of irrevocable trust, so all bets are off at that point, right? Because you get the basis step up from the person who owned the assets when they die, and that's it. My example earlier, when the estate plan creates an irrevocable trust, that's the end of basis step up, because now the trust owns the thing. If the survivor owns the trust and they have a new stepped up basis, for example, my partner, my wife, so now she receives a brokerage account worth $100,000 and $100,000 of basis, and it's in her trust now. Well, when she eventually passes away, to the extent that there's gain there, she would get the basis step up.
Okay, well, I believe that's all the questions for today. Actually, no, now I'm seeing more. You only mentioned probate very briefly. My question is, does an estate plan need to avoid probate to do this type of planning with an irrevocable trust? I can't say irrevocable today.
That's right. No, it doesn't. And I kind of glossed over it. I'm just giving a very simple example, right? I'm saying, well, upon the first spouse's death, the plan says, go create this irrevocable trust. There's no reason you couldn't do that through the probate process. So, and this I think boils down to some personal preferences that people say, I really want to avoid probate at all costs. All right, so think about an estate plan that uses revocable living trusts. But sometimes the estate planning attorney has a view, and they say, well, probate here in this state is very efficient, and so you can have instructions in a will that create a an irrevocable trust, just as you can have instructions in a living trust that are designed upon the grantor's death to create that irrevocable trust. So yeah, it's not one or the other. You could do this type of planning using living trust or through probate.
Okay, well, those are our questions for today. A lot of good questions.
Excellent, excellent. So let me just preview. We do these every month. Next month, Rick Miller's giving a webinar on tips for beginners. I would have called it tips for tips, but I love puns. I think that might be a really interesting one. We learned a lot about Treasury inflation protected securities over the years. It's a fascinating topic, and in a high inflationary environment in particular, if you work with us and you own tips already, it's interesting to see how they actually work and how they protect against inflation. And then Rick Fine in October will be giving a webinar on Medicare. I don't know the title of that yet, but he's sort of our Medicare expert here in the firm. I'm sure that will also be very good. And finally, thank you. For taking time out of your afternoon here to listen to a webinar about estate taxes and trusts. We are Sensible Financial. My contact information is here, and our website, which has a lot of really good material, as well as we have offices in Massachusetts, and California, and our social media on Facebook and LinkedIn. So thank you all again for coming. My name is Frank Napolitano, and we will see you in a future webinar.